Welcome to Institutional FX Uncensored, your free weekly FX podcast. Listen to professional FX traders, currency hedge funds, and FX brokers from around the globe discussing the latest FX news, trends, and regulations. Be ready to navigate through the uncharted waters of the foreign exchange market like no one else has. Tune in.
Hey everyone, this is the Institutional FX Uncensored, and I'm your host, Natallia, Hunik. Our topic today is the one that revolutionized the investment world. It's micro-investments. My guest today is Andrew Gillibrand. He's the CEO and founder of Union, a distribution ecosystem for alternative investments. Formerly a manager and quant at Credit Suisse, I know he didn't want me to say that, with a strong focus on the contrarian. Andrew is now a pioneer in the world of alternative investment. Andrew, welcome to the pod.
Yeah, thank you so much for having me.
Andrew, so let's start with you. You spent your, the last part of your career in the alternative traditional asset management. How did you get an idea about starting Union? What prompted it? Perhaps you've noticed some inefficiencies in the industry.
100%.
Prompted you to start the company?
Exactly. So I was a manager, and I was managing some money for some hedge funds, and I found that the distribution part of it was really inefficient. And what I mean by that is that it was kind of disorganized, and it wasn't easy for me to connect with customers who would then provide a path to customer. And it was also very fragmented, the extent to which, you would have a relationship with this guy and he would be selling your signals into Japan. And I had a relationship with a guy in Spain and he was selling my signals into Australia. And so I was executing my investment thesis into so many places. And so it occurred to me that if I had that problem, there must be, 50, 100, 1,000 managers who have the same problem. And so we built Union to solve exactly that. So what we do now is we bring together the kind of...
But when you say distribution, I mean, you were running managed accounts, right? You were managing people's money.
Yeah, 100%. I mean, if you use the word managed account, there's a lot of distrust in the world of managed accounts as a byproduct of poor retail output, so like the kind of MAM and PAM world. So what we wanted to do is we wanted to reinvent the problem, the extent to which we could solve some of the legacy problems that exist in the world of retail managed accounts and MAMs and PAMs. And so we built a really sophisticated alternative investments platform that's chock full of innovation. And so we've got some really unique things that just don't exist in the marketplace at the moment. And we're trying to pioneer this category of alternative investment called a microfund, which is effectively, it's instead of being a fund, which is a collective of investors' capital, it's a fund that's representative of a single investor's investment. And so our technology is built on that output. That's what we're trying to achieve.
Right. Very interesting. So your technology is focused on, the inefficiency that you noticed in your previous career is the fund distribution, right? During the FX Hedge Fund Expo 2020, which you obviously were a part of, when we surveyed the audience about the biggest challenges when they are trying to raise funds, and number one issue was cited as lack of personal network. How does your platform help with that? Is it a substitute? Is it a supplement? Is it an augmentation to the personal network, or is it completely different?
I mean, it works to solve that problem. So what it tries to do is it tries to reduce the path to customer. And so if you're an investment manager, effectively you want to sit in front of a computer and you want to make sure that you're making the most of your investment thesis. What you want to do is you want to build a relationship with people who wear red ties and wear Rolexes, drink beer, and are able to connect with customers who have money. And so our technology, in the description of a distribution ecosystem for alternative investments, is bringing those three pieces together. You've got the trader, the guy who's got the investment thesis and can deliver rational risk-measured alpha. You've got the introducer, the guy who's got a Rolodex and he knows how to sell. And you've got the broker, which is your connection to the market and who can act as the capital custodian. And so we sit in the middle and we solve those problems. I'm not sure I really answered your question around solving the problem for the person who's looking to raise money. One of the things that we see very often is well, I think you know that there are millions of traders on earth. I mean, if you look at the explosion in retail over the last, I don't know, let's call it decade, there is, everyone on earth has this kind of penchant for being a professional asset manager. So everybody wants to pursue social trading and copy trading, and they want to be a professional asset manager into the future. And so our platform certainly solves lots of those problems. But the point I was trying to make was that lots of these managers come to the table saying, okay, well, I'm a good trader. Here's my track record. Give me money. And I think that often what needs to happen is it needs to be addressed in a slightly more descriptive way, where the potential manager has to some degree manifest a level of audience and success in a path to assets. Once you've solved that problem and you've shown an ability to deliver returns to customers, connecting with people who've got money is not easy, but much easier if you can build out a network. And so, I mean, again, we've learned from building the tech and selling the tech as software as a service into brokers that the game is only about selling, because you can have objectively average strategies that have lots and lots of assets and that retain those assets because they have great sales teams and great support and accounts teams that are keeping those assets in play. And then you've got really robust long run strategies that have got no assets because, well, they just don't have a sales team. And so we're trying to shorten that gap. We're trying to reduce that gap, the extent to which, to some degree, it's a leveling of the playing field. But having said that, we all know that 79.8% of managers who expect to be able to raise assets are actually not capable of managing money. And so one of the roles that we...
Interesting point you're making, because you already kind of mentioned the social trading, and I know a lot of distrust from people who actually use this platform and invested some money into them and it's a common problem, I think, in general when we're talking about FX trading, is there's a lot of unaudited track records out there, and the platforms tend to show the equity as opposed to balance, and kind of all the typical things that the typical misconduct that happens in their FX market. Does your platform address that, and how do you validate the track records of these people who are coming in? And every trader has a dream to become a manager, but I mean that probably 1 in 100 or maybe 1,000 is actually talented and actually knows what he or she's doing.
Yeah, 100%. So I wanted to address one of the things you said in the beginning. So there's a lot of mistrust in the space generally. And one of the problems is in these brokers that offer these kind of MAM and PAM solutions, it makes the broker to some degree complicit. And actually what tends to happen is a person will make the $10,000 copy or the social trading or the investment, and then they'll lose 72% of their money. And they'll phone the broker and say, well, how is it that you have this person on your platform when obviously they should have been dealing directly with the person who's making the trades and has the investment thesis? And so we want to definitely solve some of those pieces. The extent to which within the platform we have a framework much like a Psyquation or a Darwin X, you can sync an account and subjectively and objectively look at the underlying outcomes and discern whether someone is capable of making you returns. So you were talking about audited track records, and this goes to the validated Twitter account versus the unvalidated Twitter account. You can request an audited track record from a manager, and the extent to which they're able to deliver that to you increases your trust in them. But 97% of them don't have the money to audit their track records and are only able to provide you, some semblance of truth. In the world of MT4, which is the world that we live, a statement of account is always balance outcome and only reflects the latest open exposure. So you're not actually able to track the balance versus equity over time. Now, my FX Book and FX Blue, they are, to some degree, can solve those problems. Our platform provides a pure mark-to-market description over time. So we're all about mark-to-market only, not about balance versus equity. And so those are some of the kind of those are some of the pieces that are core to our technology. And one of the things that we're doing in the kind of risk space is that we've we've defined this concept called active margin, which is basically a disconnect between the trader and the executed the decisions executed into the margin. And we've created an inverse risk framework where in the old kind of MAM and PAM space, you have this risk multiplier. And so where somebody wants more risk, you would give them a trade that was twice as big, which would consume twice as much leverage, twice as fast, which actually increases the likelihood of failure. Whereas ours is capped at the maximum, and we provide a level of capital protection through the risk framework. And so when it comes to offering these alternatives, these microfunds to the end customer, the person who's making the investment, who hopes to have more money from their investment at the end of the year than at the beginning of the year, we can in fact address the risk complexity of the underlying customer, which is fantastic for the regulator because we can address, both the kind of core mandate regulatory requirements, but also the kind of TCF requirements, the treat the customer fairly requirements. And so if a person comes to us and says that they have a risk premium of 5% over long run equities, we can use our inverse risk frame to build a product that's appropriate for their risk needs. So that changes the paradigm completely for the audience. We can create and sell the irrational expectation product higher up the risk spectrum, but we can also build sophisticated risk-measured long-run alternatives for the institutional investor, for the qualified investor, for the family office, and we can do that using the same strategy that's defined by a single manager. And so that, I think, is at the core is one of the. I would say that's one of the main reasons why our technology absolutely categorically outshines anything on the market today, because we're really considering the problem as it relates to risk. How much money can a customer lose? How much money can we reasonably protect? And so if we're going to take microfunds to every long run investor on earth, if we're going to participate in the same conversations as ETFs and hedge funds and long only equity products, we're going to need to do something that drastically changes the status quo. And so our active risk framework technically addresses one of those kind of primary concerns.
Right. It's interesting that you mentioned that. So you essentially built out the framework. You've built out the framework that enables the retail investor to kind of see and visualize the levels of risk that they're willing to take and tell them about the potential upsides and downside of the investment in the fund. But let me play devil's advocate here, because you mentioned that you sell to brokers. So I think historically there's a lot of mistrust in the brokers offering even MAMs and PAMs, because a lot of people say that the managers that brokers push are the ones who are churning account, because that's how the broker
100%
money. Yeah. How do you? I mean, are you aware of this issue, and how are you?
I mean, absolutely. I mean, so this goes. It's such an interesting point, because the problem with the young emerging manager is that he doesn't manage $50 million. So he has a revenue complexity that he needs to address. So he gets $100,000 and he knows that he needs to make $3,160 to pay his rent and to survive. And so what he'll do is he'll work the $100,000 with profoundly more risk. And so our technology actually is able to discern where those kind of core underlying issues are. So and this is just pure technical, on one of our fact sheets, there is a graph that describes the cost of transaction. So both your swap and your commission charges. And so you could see easily if there is a destruction of capital as a function of additional cost. So if a guy invests $100,000 into a product that's made 11% this year, but you scroll down to the transaction table, and it turns out that the guy scalped 4,760 trades, and the cost of transaction is $11,000 equally, well, then you have a problem. So then you have to ask yourself the question, is the investor prepared to accept an 11% dollar return with an 11% cost of transaction? And if you find a customer that's reasonably okay with that, and that you can pass muster in that way, but there's no way that you're going to raise a $5 million investor, because they're just going to squeeze you on cost, because they're all about the alpha. They want to make sure that they give the end customer the best outcome. And so natural attrition, we're slowly but surely weeding out the guys that are gaming the system. Gamification, I think you addressed it in one of your questions. Exactly. We're looking at that all the time. And I think also that it goes it speaks to the 1 in 1,000. The fact is, the one of the 1,000, he's just not doing that as much as 720 of the remaining.
I think there's a market. It's been a lot. I mean, it's been talked about a lot about how at the end of the day with the gamification and all of that, the retail users are the ones who are paying the price, right? Because the retail users are typically so uninformed. They don't know where their trade goes. They don't know that Robinhood sells their trade to Citadel, and they just are uninformed, and they don't, and perhaps there are other issues that they don't know how to analyze. I mean, if they're looking at the performance and they look at this straight line, linear graph, and it looks good, they don't really know what else to look at to, analyze and walk through this process, the thought process that you just outlined, where, you look at the transaction costs, you look at how much swaps they're going to pay, you look at the risk adjusted.
Yeah, they don't understand those things. Yeah.
Not very well versed in,
100%. And the guys that are selling education are actually the guys that are selling the managed product. I mean, it's the unregulated.
Lots of conflict of interest going on.
100%. I am so vehemently opposed to any of it. I see so much destruction of money. It's offensive to me. And I think that, so there were a couple of things that I was going to say. The one was, we were talking about, the slightly irrational expectation of the retail investor. What we're actually trying to do, and it's unfortunate we were just talking about the role of education, but we're trying to educate the 25-year-old who thinks that the path to commercial success or return success is a 50% return a year, when they don't understand that increases volatility, and it makes the likelihood of failure. It increases the likelihood of failure, and it's much less likely to be an outcome that you'll achieve. Anyway, if we can start to educate the 24-year-old about microfunds until they're 30, 35, they'll be moving down the kind of risk premium spectrum, and so their risk premiums will diminish, and then they'll have a baby and they'll have a family, and they'll start to understand that synthetic derivatives, the products that you and I are engaged in every day, are a meaningful addition to every long-run portfolio. Like, it's a great way to diversify a portfolio because it's both subjectively and objectively uncorrelated to any of the other asset classes. And so I think that's one of the reasons
you are making about the derivatives, and it nicely dovetails into my next question about the asset management industry overall that has undergone many shifts in the last few decades. Rise of hedge funds, ETFs, index tracking fund, but lately we've been witnessing this massive destruction from the bottom, which is the retail investors. They can move the market by cooperating on Reddit. They trade fractional shares. They follow other successful leaders like the eToro platform and the other likes of social trading platforms. So this micro investing taken market by the storm. I mean, you don't have to buy the whole house. You can do syndicate and cooperate with other people. You can do the fractional shares. You don't have to spend thousands of dollars on buying one share of a popular stock. You can buy a fraction of it. And of course, like even wines, cars, you name it. I mean, any investable products are being like fractionalized, sliced into small pieces that are affordable to the average retail investor.
And the brokers that are making these products are pretending that they're cheaper, but they're actually far more expensive. So there's a smaller. It's slightly dishonest in that respect as well. Anyway, I'll let you continue.
Right, and then when we're talking about the derivatives market, right, and even FX market, traditionally, like this micro revolution already happened in the FX market. I mean, everyone trades cents accounts. I mean, every retail broker cents, micro, all of that. But the actual investment part of it is very interesting, and that's the problem you're trying to tackle because a lot of investors don't look at this like derivatives and FX as investable products because they're highly volatile. It's purely all about speculation. And the only kind of solutions that try to make it investable are the gamified social trading, which the concept is great, but I think there's a lot of perhaps miseducation of the retail investors about the risks, and that's why even though you follow the successful leader, somehow at the end of the day you're actually not making money as advertised. So how the thing that you are trying to tackle, the microfunds, are different, and why should an average investor consider including this derivatives or FX into their portfolios?
Well, so we talk about a thing called the discretionary edge. The discretionary edge is basically like that 5 or 10% of your net investable wealth. We're not asking you to. I wish that I'd turned my Telegram off. we're not asking you to remortgage your house or sell your quilter long run equities. We're saying that there is a place in your portfolio for a product that has both subjective and objective uncorrelation. So objectively, it's different because it's a spot product rather than a portfolio product, and there are many other, objective outputs, and they're subjectively different because they just don't behave in the same way. So those two things on their own are really interesting. And so we're saying that if you take 5 or 10% of your net investable wealth and you have a 5% risk premium over long run equities expectation, so slightly higher volatility, and you'll want to be rewarded for the additional risk, this is an amazing way for you to diversify your portfolio. So
should at least consider with a small amount, right? I know people who are going all in on crypto, which is incredibly risky, but not looking at FX as something that is worthwhile investing in. And speaking about FX, another problem with FX is obviously the fragmented nature of the market and volatility, or what used to be volatility. I mean, it hasn't been really moving much lately, which makes it less attractive as an asset class. How does your platform attempt to solve this problem?
So again, a really interesting question. Like the first thing is that if you're a manager, you need to consume the market in its current form. I mean, actually, I have to say that that's one of my life philosophies. Like the world is the world. There is TV, there's things that you like, there are things that you don't like. And unless you're prepared to step in and change it, you just have to consume it in its current form. And so there is currently diminished volatility in the market, but because we participate in a spot derivative, so something that's where the decision times, the decisions to participate, to buy and to sell something are generally short. So 5 seconds to a day or a day and a half. There is opportunity, however diminished as a function of the volatility, to participate and extract alpha. Obviously, there's a destruction in numerous. So some of the strategies that would have performed that tend to perform in periods of higher volatility are pushed to the sidelines. But then strategies that perform better in trending markets or markets that are less volatile, they start to outperform. And so that actually is a great segue into one of the core innovations in our tech, which is our ability to build a microfund, which is a product of multiple managers. So we can blend multiple traders together.
Enough of managers with completely different strategies that you can build your portfolio and get exposure to.
Exactly. So instead of building a portfolio, just like building a portfolio of shares, if you can build a portfolio of traders and you can change the traders, you can reweight them, you can rebalance them, you can organize them just like you would organize a portfolio of shares. You can build a product that can perpetuate itself into the future for the long run and meaningly deliver risk-adjusted returns over time. That's the discretionary edge that we're after. So I thought I'd turn it off. So we're definitely chasing. We're definitely just chasing, that kind of segment of the market, and it's massive. I mean,
Sorry, go ahead.
I forget now because I'm being messaged a million times. I turned it off, so I don't know why it's. Yeah, I turned it off. I don't know why it's.
So what do you think when you have enough managers on the platform, which is ultimately the goal, because you need to have a lot of them to kind of allow people to build this diversified portfolios. What do you think are the major challenges for this fund managers to scale their strategies? I mean, do you think it's the nature of the market, or is it, the performance? What are those retail investors are looking for? And I'm wondering what your answer is going to be on that, because, retail investors have been spoiled with crypto, and, everyone is looking for immediate gratification and some, really double-digit returns right off the gate. So I'm curious about what you think.
I would say that one of the mistakes that we made early on in building the platform was saying that if you have scale of manager, then you will have scale of asset raising. So you will be able to reach a bigger audience. But it turns out that you need a bigger distribution network. So you need fewer managers that are more capable of delivering into your expectation. And then again, using our multi-risk framework with the active margin piece, instead of offering 3 products being 3 different managers, you offer 1 product, but you offer it across 3 separate risks. So you can address each organized segment, your high expectation customer, the guy with irrational return expectation, your kind of moderate guy, he's mid-30s and he still believes that you can get a 50% return a year. And then the guy, he's been getting a 9% compound return in dollars with a 5% volatility for 10 years, and he's just looking to diversify. So deliver a single product that addresses all 3 of those niches. And then, of course, build out enough managers that are actually capable of delivering returns and make sure that those strategies collectively are scalable. Because if you are chasing $1 billion of assets, then you need to make sure that you can scale appropriately.
What kind of vetting process do you have for the managers who are looking to join the platform?
Well, so, the first is the trackable track record. And then on the platform, it's an opportunity to describe your success. One of the things that's really, really interesting, and I don't think is spoken about enough, especially in the world of synthetic derivatives, is the idea of consistency. So you have lots and lots of managers who trade, every instrument in their arsenal. Like, they'll trade all of the crosses and they'll trade a little bit of crypto and indices. But we find that the guys that are the most successful are the guys that are trading 3 instruments, and they trade those 3 instruments with almost religious monotony. Like it's boring and offensive to watch, but their success rate is really high. Their risk rewards are really high. Their ability to deliver month after month after month is exceptional. And so one of the things when we chat to managers and we talk about what the kinds of things that you should be thinking about, like one of the main things is we say, cut down the number of instruments and cut down the number of trades that you make. So, they seem obvious, but those are the things that are the hardest to get across. It's like, in sport, when you learn how to pass the ball, there's only one way to do it right. It's the simple things that are important. And then
you need to practice 10,000 times.
100%, you need to practice. But if you can take just the 77.4% of the best trades and leave the 22.6% that you don't like, the 26.6% that you don't like, you'll be a better trader. If you can take the 17 instruments that you currently trade and work out where your sweet spot is and just be diligent in your approach to extracting returns from that sweet spot, you'll be a better trader. And so you'll raise more money, you'll take less risk, you'll make more money, you'll raise more money, you'll take less risk, you'll make more money. Like it's a big circle. But if you need $100,000 to make $3,140 a month, the likelihood that you'll destroy that $100,000 and won't get a second chance to play is very high,
Right. And it's good that you already
love what you do.
Couple of things, several advice points for the managers. But do you think, what else do you think the FX fund managers should offer to become more attractive for potential investors?
Well, I think so. One of the problems we've recently solved is a regulatory wrapper. And so that's one of the things that we can now, regulation is fundamental. Like it should be the start of a conversation, You shouldn't invest in something just because some guy tells you he's got a robot that looks really good on paper. Anyway, and so I think that's so important. Like you should want to be regulated. You should want to answer those questions up front. Like that's how we're going to build trust.
When you're saying be regulated, you're talking about the actual manager that he needs to or she needs to be regulated.
Yeah, actually, at that FX Expo, we chatted about. In fact, I think that was the primary conversation, and I think that we never got. I feel like we never got across the idea that the barrier to entry are so high. Like, if you actually want to go to the FCA and get regulated and get a license, like it's a 2-year waiting period. There's a whole bunch of hurdles that you need to jump through. I'm suggesting that those hurdles are very important, right? But for the guy who's just getting started and he's young and he wants to be a professional asset manager, and that's his career path, we want to reduce the barriers to entry. So I think that these kind of wrapper opportunities are definitely a way to go. And so Yeah, I think that
going under someone else's umbrella.
Yeah, like umbrella regulators, SPAs to asset managers, those kinds of things. I think that those are definitely ways to solve that problem. So they can come to us.
Right. Excellent. Andrew, phenomenal. Thank you so much for sharing with us more information about the world of microinvesting in FX, and good luck with your platform. Is there any channel that people get a hold of you? I will include your LinkedIn profile in the show notes, but if you have a Twitter handle or some way for people to get in touch with you, feel free to share.
I am Gilly the Kid on Skype. That's GILLITHEKID. That is it.
Okay, excellent. Andrew, thank you so much for coming over and sharing your expertise about microinvestment. Good luck with the platform.
Thank you. It's a great pleasure, and I look forward to chatting to you many more times in the future. Thanks, Natallia.
Absolutely. Thank you. Fantastic. Thank you. Bye-bye.
Any views or opinions presented on this podcast are solely those of the author and do not represent those of Advanced Markets. Trade in foreign exchange or other financial instruments on margin carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you as well as for you. Before deciding to invest, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or more of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with trading and seek advice from your broker or an independent financial advisor if you have any doubts. Anyone opening a live trading account needs to adhere to the laws of their local country, as such laws may differ from country to country. Advanced Markets expressly disclaims any liability for any lost principal or profits without limitation which may arise directly or indirectly from the use of reliance on information provided through this podcast.